Have you ever wondered how, well, as a self-employed individual or maybe a small business owner, you truly navigate the tax world? I mean, it's one thing to earn the money,
Right.
but understanding how the IRS actually sees that income and, what costs you can legitimately deduct, that's a whole other ballgame.
It really is. It can feel pretty complex.
So today, our deep dive is all about pulling back the curtain on business income and expenses, specifically looking through that crucial lens of IRS Schedule C.
The cornerstone form.
Exactly. Our mission here is to equip you, our listener, with the essential knowledge you need to confidently approach your business's financials. We want you to be well-informed and, frankly, ready to tackle this vital part of being self-employed.
Absolutely. Knowledge is power here.
Okay, but before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat Lectures.
Great resource.
Yeah, all the content, the examples, explanations, it all comes straight from farhatlectures.com's extensive accounting resources. So whether you're maybe an accounting student studying for the CPA exam or already a professional looking to sharpen your skills.
Or just curious.
Or just curious, yeah. Swing by the site. They've got more practice questions, video lectures, detailed support, all reinforcing today's topic. Big thanks to Professor Farhat for providing this material.
Definitely valuable stuff.
Okay, let's unpack this then. We're talking business income. It seems simple, right? Money you earn from your business.
You'd think so.
But the IRS has specific criteria. And if you overlook them, well, that could lead to some unexpected tax surprises. So what does the IRS actually consider business income?
Yeah, this is fundamental. What's fascinating here is the core definition. The IRS sees business income happening when a taxpayer is, like, actively engaged in a trade or business.
Actively engaged.
Right. And with the clear purpose of making a profit, it has to stem directly from your own skills and efforts. You're working for yourself, not as someone's employee getting a W-2.
Okay, so that W-2 versus non-W-2 distinction is
A
key.
huge distinction. If you're self-employed, an independent contractor, a sole proprietor, you're earning this money independently from your own work.
And Schedule C is where it all happens.
That's the place. To report this income, and crucially all your related business expenses, you use IRS Schedule C. It's like non-negotiable for self-employment reporting, and it's broken down pretty logically. Part I is for your income, Part 2 is for your expenses.
Gotcha. So to make this real, let's imagine someone, Sarah, maybe a freelance graphic designer. How would her numbers, her income and expenses actually flow through this Schedule C?
Okay, good example. Let's say Sarah's graphic design business, she's doing well, brings in gross income of $300,000.
Nice.
Yeah. And she has legitimate business expenses, maybe software, supplies, marketing, totaling $100,000.
Sure.
Her net profit, that's the term the IRS uses, net profit from business would be $200,000, right? 300 minus 100.
Simple math so far.
Simple math, yeah. But here's the important part. That $200,000 doesn't just sit on Schedule C. It flows over to her individual tax return.
Okay. So it connects to everything else.
Exactly. It goes on to Schedule 1 first. That's a sort of summary schedule for additional income and adjustments. And then that number transfers directly onto her main Form 1040.
Wow. So it really becomes a central piece of her total taxable income.
Absolutely crucial piece.
So it's not just cash Sarah's bringing in, right? I mean, what if a client pays her with, say, some equipment instead of money? How does that work?
That's a really important point. Cash is most common, obviously, but business income can definitely take other forms. If she receives property instead of cash, like that equipment,
Yeah.
she has to report it as income at its fair market value, what it's worth right now.
Okay. Fair market value. Got it.
Or maybe she barters services. She does design work for a web developer who builds her a new website. That's income too, based on the value of the services received.
Even canceled debt.
In some specific business situations, yes. If a business debt is forgiven, that can sometimes count as income that needs reporting. It's less common, but it happens.
Good to know.
And one more thing, if Sarah maybe sits on a board of directors for another company or does some consulting work where she's not an employee.
Right. Acting as an independent expert.
Exactly. That income is also considered self-employment income. And guess where it goes?
Let me guess. Schedule C.
You got it. Right there on Schedule C.
Okay, so income is sorted, more or less. But then comes the big question for Sarah, and really any business owner. What can you actually deduct?
The deductions.
This is where I feel like a lot of people get tripped up. The rules seem really specific, maybe even a bit tricky sometimes.
They can be. I mean, ideally, you just generate income without expenses, right?
Wouldn't that be nice?
Yeah, but reality bites. You incur income, you inevitably incur business expenses. The key, though, is that not every single expense is deductible.
Right.
For an expense to make the cut, it has to meet three crucial criteria, and people often overlook one or more of these.
Okay, what are they?
First, it absolutely has to be directly related to your business. Obvious, maybe, but essential.
Makes sense.
Second, it needs to be ordinary. That means it's an expense that's common and accepted in your particular line of work.
So, like, for Sarah the designer, buying design software.
Perfect example. That's ordinary for a graphic designer. Buying, say, a surfboard probably isn't unless she's a pro surfer giving lessons.
Gotcha. Okay, what's the third?
Third, it must be necessary. This means it has to be helpful and appropriate for developing and maintaining your business.
Like advertising.
Exactly. Advertising her services to get new clients, that's necessary. These rules-related, ordinary, necessary are super important because they stop people from trying to deduct purely personal expenses.
Right, like trying to write off your family vacation as a business trip.
That's a classic audit trigger, yeah. The IRS is wise to that stuff.
Okay, so that distinction, personal versus business, is critical. And that brings up something else that often confuses people. This idea of for AGI versus from AGI deductions. Can you break that down? Why does it matter?
Oh, this is such a critical distinction. It can really impact your overall tax, bottom line. Business expenses on Schedule C. They are for adjusted gross income deductions, often called above-the-line deductions.
Okay, for AGI or above the line means what exactly?
It means they get subtracted before you even calculate your adjusted gross income, or AGI. Think of it like taking those costs off right at the top.
Okay.
And AGI is a really important number on your tax return. Why? Because so many other things, limitations on other deductions, eligibility for certain tax credits, even some state tax calculations are based on your AGI.
I see. So lowering your AGI early on can have knock-on benefits.
Huge potential benefits. It can open the door to other tax breaks further down the line. In contrast, you have from AGI deductions, those are things like itemized deductions on Schedule A, medical expenses, state taxes, mortgage interest.
Right.
Those are taken after you've calculated your AGI, so Schedule C expenses hit earlier and can have a broader impact because they directly reduce that key AGI figure.
That makes a lot of sense. It's strategic.
Very strategic. Oh, and a quick note, self-employment health insurance premiums, they're a bit unique. They aren't actually on Schedule C itself.
Oh, where do they go?
They're an adjustment to income to arrive at AGI, usually on Schedule 1. So they still help lower your AGI, just not directly within the Schedule C calculation itself.
Okay, good clarification. So it's not just about spending money. It has to be a legit business cost, serving a clear purpose, and deducted in the right place. Let's dive into the nitty-gritty then. What are some of the most common expenses you see showing up on Schedule C? Like for our designer, Sarah, or, any typical small business?
Sure. There's a pretty standard list. A really big one, especially if you sell physical products, maybe you run an Etsy shop or a small retail store, is cost of goods sold, or COGS.
Right, what the inventory actually cost you.
Exactly. What it cost you to make or buy the stuff you sold. Then you've got salaries, wages, and bonuses. But this is a key point. It's only for amounts paid to your employees.
Not yourself.
Absolutely not yourself. If Sarah pays herself a salary, that's not a deductible expense on Schedule C. That's considered an owner's draw or withdrawal of equity.
Ah, okay. Big distinction. What else?
Rental expense is common, maybe renting machinery, specific equipment, or, office space.
What if you pay rent in advance? Like for the next 6 months?
Generally, prepaid rent is only deductible in the tax year where you actually get the benefit or use of the space or item. You usually can't deduct it all up front if it covers future years.
Yeah.
Commissions paid out maybe to salespeople or other businesses helping get clients, those are deductible. And advertising expenses, of course. Got to spend money to make money, right? That's usually necessary.
Makes sense. What about taxes? Can Sarah deduct, her income taxes on Schedule C?
No, definitely not personal, federal, or state income taxes. The taxes deductible on Schedule C are those directly related to the business. Think payroll taxes for employees, if she has any. Sales taxes collected and remitted, though that's often handled differently. Maybe specific industry or occupational license taxes. It has to be a business tax, not a personal one.
Got it. Business taxes only.
Right. Also, office supplies, paper, pens, staples, that kind of stuff. And depreciation expense.
Ah, depreciation. That sounds complicated.
It can be, but the basic idea is for larger assets used in your business, like a computer, a business vehicle, machinery. You don't deduct the full cost in the year you buy it. Instead, you spread that cost out, deducting a portion each year over the asset's expected useful life. And again, it's only for business-related property, not personal assets.
Okay. Spreading the cost over time. What about meals? Can Sarah deduct lunch meetings?
Yes, business meals can be deductible, but there are rules. It generally covers food and drinks when you're traveling for business away from home or when you're dining with a client, customer, or business associate with a reasonable expectation of conducting business.
Reasonable expectation. Sounds a bit vague.
It is a bit subjective, but the primary purpose should be business. Now, historically and typically, you could only deduct 50% of the cost.
Only half. Why?
The rationale is that you have to eat anyway, so there's an element of personal benefit. The IRS splits the difference, essentially.
Okay, 50% generally.
Yeah. Now, there was a temporary rule for 2021 and 2022 allowing 100% deduction for food and beverages from restaurants to help that industry, but usually it's 50%. Always check the current year's rules.
Good tip. And what about business gifts? If Sarah sends a holiday basket to a top client.
Business gifts. There's a strict limit here. You can only deduct $25 per recipient per year.
Only $25, even if the basket cost $100.
Even if it costs $100. You spend $100, you deduct $25. That's it. It's been $25 for decades. Hasn't kept up with inflation at all.
Wow. Okay, $25 limit on gifts. Good to know. Any others?
Yeah, a couple more common ones. Bad debt expense. This is when a customer owes you money and you determine you're just not going to collect it.
So you can just write it off.
You can, but only if the debt is truly worthless and you actually write it off your books using the direct write-off method. You can't just estimate potential bad debts for tax purposes like you might for financial accounting. You wait until it's actually gone bad.
Direct write-off only. Got it.
Insurance expense, things like business liability insurance, insurance on business vehicles or equipment, malpractice insurance if relevant, all deductible if purely for the business.
Makes sense.
And finally, automobile expenses. If you use your car for business, you've got two main options here.
Go.
You can track all your actual expenses, gas, oil, repairs, insurance, depreciation related to the business use percentage. Or, much simpler for many, you can use the standard mileage rate set by the IRS.
The standard mileage rate, I've heard of that.
Yeah, you just multiply your business miles driven during the year by the rate. But be aware, that rate can change annually, and sometimes, like we saw in 2022, it can even change mid-year.
Really, mid-year?
Yep. In 2022, it was 58.5 cents per mile for the first half of the year. Then it jumped to 62.5 cents for the second half due to rising gas prices. So you got to use the right rate for the right period.
Wow, okay. Need to pay attention to the dates there. That's quite a list of common deductions. But I know some things have even trickier rules or just flat out aren't allowed on Schedule C, like business interest. I hear that can get complicated.
It definitely can, especially for larger businesses. So interest business expense. The general rule is simple. If you incur and pay interest on debt specifically for your business purposes, it's generally deductible.
Okay, sounds straightforward enough.
But there's a major limitation that kicks in primarily for larger businesses.
Yeah.
There's a cap on the amount of business interest expense you can deduct each year.
A cap. How does that work?
The deduction is limited to 30% of the business's adjusted taxable income, calculated before considering interest income, interest expense, depreciation, and a few other items. It's a specific calculation.
30%. Okay. Does that apply to everyone? Like Sarah, our graphic designer?
Probably not, and that's the key. This limitation only applies if the business is considered a large company by the IRS definition.
And how do they define large for this? Is there a dollar amount?
Yes. Generally, a business hits this threshold if its average annual gross receipts for the prior 3 years exceed an inflation-adjusted amount. For recent years, that threshold was around $27 million.
$27 million. Okay, so most sole proprietors, freelancers, small partnerships. They're likely well under that.
Exactly. For most small businesses and self-employed individuals listening, you probably don't need to worry about this 30% limit.
Yeah.
You can likely deduct all your legitimate business interest expense.
That's a relief for many, I'm sure. But what if a business does grow and cross that threshold? Say their average is $28 million.
Okay, then the rule bites. Let's say that business has $5 million in actual interest expense for the year. But after doing the calculation, taking their income, subtracting operating expenses, but not interest or depreciation yet, they find their adjusted taxable income for this purpose is, say, around $9.7 million.
Okay.
They take 30% of that $9.7 million. That comes out to roughly $2.9 million.
Ah, so even though they paid $5 million in interest.
They can only deduct $2.9 million in that year because of the 30% limitation.
Wow, that's a huge difference. What happens to the rest? The part they couldn't deduct? Is it just lost?
Thankfully, no. The disallowed amount, in this case about $2.1 million, isn't lost forever. It gets carried forward and can potentially be deducted against business income in future years, subject to the same limitation in those years.
Okay, so it carries forward. Still, that's a major planning point for growing businesses hitting that size.
Absolutely. It significantly impacts tax planning and cash flow once you cross that $27 million average threshold.
Good to know. So besides that interest complexity for larger firms, what are some common things that people think might be deductible on Schedule C but absolutely are not?
Right. There are several definite no's for Schedule C. Charitable contributions are a big one. Generous, yes. Deductible on Schedule C, no.
Where would that go, if anywhere?
If you itemize your deductions, it could potentially go on Schedule A, but it's a personal deduction, not a business expense.
Okay. What else is off limits for Schedule C?
Entertainment expenses. Used to be partially deductible years ago, but now? Generally, zero deduction for entertaining clients, things like sporting event tickets, golf outings, etc. Business meals are different, as we discussed, but pure entertainment is out.
Got it. Entertainment is a no-go.
Your personal share of state and local income taxes, again, potentially an itemized deduction on Schedule A, subject to limits, but not a business expense on Schedule C.
Right. Separates personal and business.
Personal investment interest. If you borrow money to buy stocks or other personal investments, the interest isn't a Schedule C deduction. There are separate rules for investment interest.
Okay.
Your personal share of mortgage interest and property taxes, even if you have a home office, you have to allocate between the business use, which can be deducted often through a simplified home office deduction or detailed expense tracking, and the personal use part. The personal part goes on Schedule A if you itemize.
Makes sense. Allocation is key there.
Federal income taxes. Never, ever deductible, period.
Okay, clear enough.
And circling back to what we said earlier, salaries, wages, or bonuses paid to yourself as the owner of a sole proprietorship or partnership, not an expense. That's you taking money out of the business and owner's draw.
Right, not a business expense, just moving money to your personal pocket.
Exactly.
Okay, so we've covered income, we've covered a ton of potential deductions, we've covered what's not deductible. After you net all that out on Schedule C, what's the final result? What does that bottom line mean for the taxpayer?
Well, you end up with one of two things. Either a net income or a net loss.
Income or loss?
If you have net income, that's generally good news. Your business made a profit. But that profit is typically subject to two types of tax: regular income tax and self-employment tax.
Ah, the double whammy. Income tax plus self-employment tax.
Pretty much. Self-employment tax covers your Social Security and Medicare contributions since you don't have an employer paying half.
Right. What if it's a net loss?
If you have a net loss, it means your deductible expenses were greater than your business income for the year. The good news is that loss might be deductible against other sources of income you have.
Like income from a job or investment income.
Potentially, yes. It can reduce your overall taxable income, which lowers your tax bill. However,
There's always a however in taxes, isn't there?
almost always, there's a limit on how much business loss an individual taxpayer can deduct against their other income in a single year. It's often called the excess business loss limitation.
A limit on losses, too. How much is that?
It's indexed for inflation. But for 2022, for instance, the maximum business loss you could deduct against other income was $540,000 for married couples filing jointly, and half that, $270,000, for single filers.
Okay, so 270K single, 540K married filing jointly for 2022. That's a pretty high threshold, but still a limit.
It is. And again, these numbers can change. So if your business loss exceeds that limit for the year...
What happens to the excess? Does it just vanish?
No, thankfully not. Any loss disallowed because of this limitation isn't lost. It gets treated as a net operating loss, or NOL.
NOL, net operating loss.
Right. And that NOL can generally be carried forward to future tax years to offset business income in those years. So you don't get the benefit immediately against other income, but you can use it down the road against future profits from the business.
Okay, so losses have limits, but disallowed amounts can carry forward as NOLs. That's complex, but important.
Very important, especially if a business has a rough year or significant startup costs leading to a large initial loss.
So wrapping this all up, what does this really mean for someone listening? We've really taken a deep dive here into the world of Schedule C. business income, all those deductions, the tricky rules, even loss limitations.
Yeah, we covered a lot of ground.
It seems pretty clear that getting these details right isn't just about, staying out of trouble with the IRS. It's fundamental on actually understanding the financial health of your own business.
Absolutely. Understanding this isn't just compliance, it's business intelligence. Knowing what counts as income, what's a valid expense, how these things flow through to your personal return, it's crucial.
Our goal was really to give you that shortcut, that path to being well-informed. Hopefully you had a few aha moments listening today, thinking about how these rules apply to your own situation.
And maybe the biggest aha moment isn't just memorizing a list of deductions, it's appreciating that this stuff changes. Tax laws evolve. Staying curious, staying informed. That's an ongoing process. It's vital if you're building a business or even just managing your own finances effectively.
That's a great point. Tax laws aren't set in stone. What new change might be just around the corner? And the real question for you, the listener, is how will you stay ahead of the curve?